Welcome everyone to this Friday webinar. Keeping the rhythm, ahead. We have kept this very interesting webinar this Friday with Sandeep Maheshwari, who is Senior Executive Vice President with 361, on the topic pertaining to something which is new, which is emerging in the alternative space, which we call as secondaries. We'll understand, why we call this as new emerging opportunity for creating alpha, and we'll start by maybe understanding the concept itself, and then progress this discussion ahead with Sandeep. It will be more of an educative discussion. We are not going to discuss any product, and it's not going to be about any recommendation. In the audience, Sandeep, we have our clients and our partners who are keen to learn and understand the concept of secondaries, and 361 has been an alternatives focused asset management company, and has always been pioneer in figuring out new ways to create alpha. And I understand this particular concept is also emerging in Indian context, and you have been pioneer, and being a fund manager, it is like our fortune to understand and learn from you. This is the intent of this webinar. So maybe a quick introduction from your side.
Sure.
I understand that yes, you have around 1.5 decades of experience, and you kind of head this space in 361. But maybe from your side, if we understand your entire detailed background as a fund manager, and then a concept on introductory concept on secondaries, and then move ahead.
Sure. Thank you so much, Kamal, for having me here, and thanks everyone for joining this call. So firstly, a quick background about myself. Been part of 361 for more than 2.5 years. I take care of 3 strategies within the private equity team: the fund of funds, secondaries, and co-investments, and the multi-asset funds. Now, we are within 361. We are LPs to more than 14 funds. We have, in fact, launched amongst the first secondaries fund in the country as well, and already invested in 10 such transactions too, within a span of 6 months. Prior to this, I was have been in the investment banking space with Edelweiss, Axis, and addendum. I've had the experience of more than 16 years, largely been sector agnostic, focused on late stage itself, and focused on the equity cap markets. So with that, let me just jump into the topic as Kamal highlighted. So secondary is essentially one investor. While we have seen this much more naturally in the listed markets, in the unlisted market, when companies are private, the phenomena of one investor selling to the next investor, that is what is a secondary transaction. Unlike a primary transaction in which an investor is investing into the company and the money is going inside the company, in a secondary transaction, essentially one investor is selling their shares, their units to the other fund or the other person. And that until now in India was not really a very large market, but that's developing very fast as this entire industry has grown further. So in simple words, it's just about selling from one investor to the next investor with few differences. Number one is that when it's not a primary transaction, typically these secondary transactions happen at a discount. And the other aspect is that this typically happens once an investor has been invested for a relatively longer period of time. So that's just giving you a quick overview of what secondary transaction could look like and what it is. Happy to double click on anything that Kamal you would suggest we should.
Sure. So the foremost question that comes to my mind is that let's imagine there is a fund which started in 2016-17 and it has been able to create a portfolio of 10 to 12 private company investments, and now it's got exit from say 50% of companies, and remaining 30-40% companies are yet not exited, and you come in as a bridge to provide them exit and solve their problem, because the company is getting time for it to get maybe listed or fund to exit that. Now at that juncture, obviously you are providing a solution to that fund, but at the same time, from investors' perspective, who is investing in your fund would definitely have this question that you are going to get something which is left over in the older portfolio. How does it come out as an attractive investment opportunity from investors' point of view?
Of course. Thanks for that question, Kamal. Interestingly, I think just on sort of taking this forward, within secondaries, there are 2 or 3 types of secondaries, right? One is what you're saying is a portfolio buyout, that there is, say, 12 companies invested, 6 or 8 are left. and all these 8 are sold to the next fund. That's one type of secondary sale that happens. The other and most frequent is single asset sales, that you still sell single asset, each asset by asset to investors. While the third type is when LPs themselves sell their units in a particular fund to those investors. Now, coming on to the question in terms of selection, I think typically of course, when there's a buyer looking at a portfolio or something, they would like to choose the winners from that portfolio, while the seller would be interested in having some of their not so good companies as well, not so at this point in time, some of the lemons as well associated with that portfolio. And that's where filtration comes in, that you tend to filter out, you don't take the entire portfolio, filter out those companies that you would believe would be perfect from your own secondary fund perspective. Now, from a market backdrop perspective, today what has happened is in the last, since 2012-13, when the AIF regulations really started coming in and when the regulations came in, most of the funds that have come up with a fund life of 8 to 10 years or something around that, right? Till now, between 2012 or 2013 till about 2023, close to about $400 billion has been invested in the Indian markets by these funds. And now what has happened is today that a lot of these funds have not really been as effective in terms of selling because of there were various backdrops which were there in the past. Earlier, you could extend your fund life quite regularly, which is not something which is possible now. Earlier, there was never such a focus on giving back to the investors their capital back, which is again a phenomenon happening now. And overall, Indian markets have developed quite much. And therefore, suddenly what you've seen is because of these three big drivers, it was in fact any private market that it develops also develops its secondary market at some point in time when the primary investments mature. And that's exactly what is playing out in market, but it's just getting triggered by two other events, which, as I said, was one from a regulator perspective, second, just from an investor perspective, that everybody is focused on seeing some return, on getting some DPIs from these funds. So suddenly you've seen a market where there are a lot of funds who would like to sell, who would be on the cusp of either end of fund life or would like to just monetize to show higher DPIs. And there are very few buyers because this industry has developed only in the recent times, and we've been sort of early to cite this trend and really launch our fund and have raised and, as I said, deployed from this. But there are not very lot of buyers at this stage, and therefore the chance you have in this vintage is, of course, that they are given the sellers a multiple. You have a choice to make which investments you would like to pick and so on. And even otherwise, the investors who is coming in at that point in time will really go into each of the assets that they're buying. And only once it's making sense will they be acquiring those assets. So it's a filtration process that happens. The market backdrop in this vintage, of course, is skewed towards the buyers, that there are limited buyers but multiple sellers. And of course, the fact that you can negotiate a discount according to the quality of the company in a very reasonable way, which gives us a better alpha for us and the investors coming in the fund. So that's a quick take on the point that you were making as to how you filter out these opportunities.
Sure. No, so I understand that, yes, if primary market is like quite huge, there is definitely a lot of potential in secondary market and you're bridging that gap. But within that filtration process, what is the list of do's and don'ts? What is your target universe of companies that you will pick? How will you actually eliminate? What is that process? What is that rule book? Is what I am keen to understand.
Sure. So I think each investor has its own mindset, Kamal, in terms of doing secondary transactions. Some of them would like to have a wider bouquet of assets that they can say, so that there is good diversification within the entire portfolio that they're acquiring. While few are focused on single assets, which they would like to double up on or would like to go aggressive on. And there are options available on either side and strategies available on either side. Having said that, from our perspective, the vantage point that we had and what we are really focused on is to look at only late-stage transactions. There are quite a few companies, Kamal, today where companies inherently are doing good, but they're not yet there from a capital market standpoint, and they would need that additional 2-3 years really to launch their IPO. But in companies intrinsically, from inherently what they are doing, the way they are growing, the way their unit economics is developing is extremely, extremely strong. I mean, there are multiple such examples which are happening in this space itself. Recently, you've had many single asset as well as very few portfolio asset deals that have happened as well. From our perspective, we are focused only on late stage transactions because that's where we believe is the play. At this juncture, there are multiple such companies who want that 2-3 year period for themselves to really go for their IPO. We have been very again a pioneer from a pre-IPO market perspective, and hence really see what is that element that is needed for a company to go for its IPO and what can we solve for. And we are really looking for those. I think wherever we are seeing the scale, which is increasing, which is at a very, very good level, profitability or unit economics, which is already profitable or just about to be turned profitable. I think those are the only assets that we are buying in. One of the examples that I can give you right now is a jewelry company which we have invested about 6 months back. I think again, it's been seen that asset. It was growing extremely well in the recent times. However, some of the investors had invested since a very, very long time. The real inflection point came 2 years, 3 years back, while investors have stayed invested for 10 or 11 years. So those investors needed an exit in this company. And just the moment that played out, we saw a huge re-rating in that same asset when multiple other investors also acquired interest because the whole problem of that cap table was solved. And it's not just one such example. There are multiple such companies where such transactions are happening. Given, as I said, it's always a great time to invest when there are few buyers and multiple sellers. I think that gives us a huge advantage in terms of picking the ones that we would really like to double click on.
So what is the success rate so far in terms of identifying such opportunities, and what is the potential in terms of creating the portfolio? And I'm not asking you to share any indicative or expected returns, but in terms of otherwise from investors' point of view who ultimately invest in late stage companies through this route, how to assess what kind of success you have attained so far, and how to understand what's your track record so far.
Sure. So I think, Kamal, I'll go global first and then sort of come back to India standpoint. I think globally, this market has really grown extremely big. In fact, if I talk to you about US or Europe or any of the advanced economies, the secondary market itself is much, within the private equity universe, is much larger than the primary market. And that's just the sheer nature as things progress. Not every company will go immediately in that IPO within that period of time. It takes sometimes some take longer, some take quicker. And therefore, you need to have the solution, which is really needed. And that's why this industry has flourished globally. And there have been multiple funds which have been launched and have had extremely strong return track record for them. In India, this is something which is just developing. Now, first and foremost, what happens in a secondary transaction is you negotiate a discount. Unlike a typical primary company in which you invest at the FMV or very close to the FMV itself, here in a secondary transaction, you can come at a discount because these secondary transactions, because of its nature, it's done at a discount. So first is you get a better safety cushion in terms of pricing from these companies' perspective. The second thing that we've been lucky, we've done 10 investments. We've seen 2 or 3 listings within the portfolio and otherwise as well, which has seen some extremely strong result for us even right now. In the past, I think where we had also done from some of our other funds, some of the secondary transactions, which were part of the overall private equity pool. And again, we have seen some really strong results on those. Now, what happens? Why such phenomena usually happens, Kamal, is the fact that typically when you do late stage, the chances of that company staying illiquid for long is really reduced because you are coming only at a late stage when these companies are fully primed up for a listing, for an exit in 2 to 3 years itself. Secondly, these are very established business models, and therefore your risk is mitigated in that sense. And thirdly, I think given the pricing that you are able to negotiate, because what public markets, in fact, before listing also don't really appreciate a lot is the fact that there is a very weak cap table or a cap table which will come to sell its shares very quickly. And secondary really solves that problem. And therefore, what happens is when a secondary player is coming in and buying a stake, he typically negotiates a better discount before coming in these companies. So we have had such situations where we have taken such discounts. Globally, this discount is much larger. In India, for late stage investments, it's a different number. But for mid stage and early stage transactions, again, it's a very, very steep discount that is being discussed or is negotiated as well, because that's really something that a GP needs. As the Indian LPs have really gone for asking these investors to show the distributions back or to give the distributions back, a lot of investors are forced to sell their positions which they would have otherwise liked to hold longer. And which is where I think is the moat, which is where we are playing from, as I said, from a late stage perspective, and the kind of opportunity that we have, that we have been able to negotiate some good discounts at the entry price point itself.
Sure. Conceptually, when it comes to investing from the point of view of investors, they are always, worried about valuations as one very important factor.
Right.
I remember having done webinar like this with Arup Maheshwari, who heads your listed equities, and he also mentioned that one factor which is absolutely important is valuations. And today, if we see listed space, I can refer to a lot of data points that were referred even in that webinar, were kind of throwing that given the price to book of market and other valuation parameters, listed space looks to be expensive.
Right.
How does it play? How does it play out in your unlisted segment of late stage companies that you look at? What kind of valuation multiples you kind of look at, or if you have any, I would say, attributes of the existing portfolio of or bouquet of companies in terms of valuation at which you're comfortable entering,
right,
from concept point of view.
Right.
Why I'm asking this question? Because many investors have seen many of these successful IPOs which came like Zomato and all. They came at obnoxious valuations, though obviously stock prices kind of went down and then again have gone up when maybe companies have started to show profits and the understanding about business is definitely improving. But at the time of investing from your fund in such companies through secondary route, what are the valuation multiples that you look at?
Right. So Kamal, I'll just take it from a more overview level instead of going specifics about companies and the valuations that we have entered. But I think what is playing out today is there are a certain set of companies, as I was saying, that and you also hinted that listed world is trading, of course, at a premium multiple. But when we look at any company today, we are looking at really what that fair market value should be in a normal period. It's not a period that we see in terms of current listed multiples, but a fair market value is what we call. Where a lot of thesis, a lot of work goes behind in terms of assessing what that would be from a normal market perspective. Of course, these are euphoric times in some sectors and pretty okay in some of the others. But having said that, when we see any asset, it's more firstly taken at a normal level itself. What is that fair market value of this asset could look like? And then we apply a discount to that asset based to that valuation. And that could be you could see some of these multiples could be from a when we are looking at a fair market value, you see a 2-year forward or 1-year forward, depending on which stage the company is in terms of EBITDA multiple, in terms of PAT multiple, or sales multiple at some point in time as well. And then thereafter, you apply a 10, 15, 20, 25, 30% discount. There have been deals that we have invested in fact, where we have seen within 6 months, almost the next round happening at double the price. And that's unique, right? And in such markets and private markets, you don't hear in these times, leave aside the 2021 period and early part of 2022, when some of the companies were raising new rounds at double the valuation frequently, or at least it was a lot more frequent. But currently, there have been hardly any companies which have really raised another round at a higher price within a period of 6 months. But that's what is exactly happening from a secondary perspective, where we invested in a company about 6 months back, and within 6 months, we have seen prices doubling because of the fact that business is growing, but more importantly, the cap structure issue has been solved. Similarly, I think from a pricing perspective, the second thing that does play out is if the asset takes longer. So see, when we are coming in late stage assets, it's not about we are coming in dud assets where you can really take. That's not the idea as well. There are funds which are working from a 50, 60, 70% discount as well that they would like to attract for. We're not really one of those that we will, because those assets are also not really something which are which would get you that kind of return. But having said that, a great asset that we could get in, figure out a fair market value in a normal market condition, and then apply our 10, 15, 20% discounts really gives us that edge. What is needed to give the additional return to the investors? And in this market, I would say 2 or 3 years back, there was a period when private markets were soaring high, public markets were sort of, from a valuation perspective, were not there yet. Having said that, now it seems to be the other way around, that public markets are soaring high, while private markets have seen a lot of correction, if not price correction, time correction. In fact, in some cases, both the corrections have happened. And therefore, from our perspective, the valuations that have been negotiated now have been at a significant discount. So just to give you some examples, Kamal, when we start a discussion, we start at how much is the discount effectively in some of the assets, right? It's earlier when there was a new round happening, when somebody else was coming in, it's always this is the premium, or next round will be done at this level. While now we are talking of okay, so last round, be it 2 years back, 3 years back, whatever is the last round, or it could be recent as well. In some of the assets, so we've seen there's been a significant re-rating or a de-rating which has happened from a valuation perspective. And that all plays out well. And I think the other piece from a secondary lens is, Kamal, that unlike a primary investment where founder gets affected because he's getting that dilution, each and every shareholder is being diluted. In a secondary transaction, it's only that investor selling. Founder also is towards, in a lot of cases, so in fact, all the 10 investments we've done, founder has been on our side, that you are the incoming investor and you should also sort of be taken care of. The outgoing investor, from a negotiation perspective, it's the founder which comes on your side in terms of helping you get the right valuation, as compared to a primary round where founder is always on the other side in terms of negotiating for valuation. So I think a lot of factors do play in this market, in this vintage. From a buyer's perspective, of course, we are able to get some attractive discount, and which is what we've seen in not just one, but almost each of the assets that we have invested till date. 4 have already seen within 6 months. In fact, 6 such investments have already seen a good, healthy markup, not just because of inherent business position, but actual rounds happening in these.
Sure. So I understand that, you look for a quality asset with foreseeable growth, maybe a company, at some inflection point. But yes, there is a time period of 2 to 3 to 4 years, which you have to kind of travel for that company to give you exit.
Yeah.
And early investor is like not having that time, and you come in and, again, for that time, buy that asset. Now,
Yes.
obviously, you also get relatively attractive valuation by getting some discount. Obviously, it all sounds to be quite interesting because it's a growing asset and you're buying at an attractive discount. And obviously, you have your investor who has given you a time period in your fund, because your fund is creating the portfolio at this stage. Now, I am trying to think from investors' point of view. From here onwards, if you have created a portfolio of such companies, what are still said risks which are there, which you would want to kind of highlight in terms of still from here onward, because company is a growing company. We cannot expect the company to suddenly get into losses or it gets into problem. Maybe exit can get delayed, but beyond these, what are the other risks which are there, which are important to be discussed?
Oh, perfect. So Kamal, I think at the end of the day, this is a private equity investment, and therefore, first and foremost, for investors to understand is that there is a bit of a lock-in here. You are investing in a Cat 2 fund, and therefore you should think through from that duration perspective. Of course, from a return perspective, the entry valuations really play a very, very important role, and therefore it's a great time from that perspective. But this amount, first and foremost, gets invested. The first aspect from a Cat 2 fund itself that investors should understand. The second, from a business perspective, given it's private equity investing, ultimately we are investing in these companies. If the company faces any specific key issue at their end, then of course it could be difficult. But having said that, given we are coming only at the late stage, a lot of these risks are mitigated to a very good extent, because these are companies which have really seen cycles and grown to a point in time that we can see some of the exit opportunities coming just in 2-3 years instead of 5-6 years, which a typical investor invests for. So that I would say is the second big thing. Third, of course, market. If market corrects further or something happens, then those are market risks which will play out here as well. But having said that, fundamentally, it's a low risk model from within the entire private equity universe, but the risks associated to the private equity as such do apply out here, which is that it's lock-in, which is that it's ultimately equity investing. Companies can see some headwinds, so very, very strong headwinds at times as well. But just that, given you are investing at a later stage, it's mitigated to a large extent. I would say that's the way one should envisage or think through this portion. Of course, if you ask me, the biggest risk could be the point that ultimately it's a 6-year fund. We are looking at assets where we can also look at exits within 3 to 4 years or earlier as well. But if these exits take longer, then that could be one of the bigger risks to my mind that could play out, that you are essentially extending fund life or reaching out or giving this cash flow later. But again, definitely gets mitigated a lot more because you're only doing late stage and not early mid-stage deals.
So, your entry point itself is thoughtful, that you're kind of figuring out companies which are where growth is visible and you're entering at late stage.
Absolutely.
Yes,
Absolutely.
there are risks in any investment, and this investment also there are all those normal risks, and obviously liquidity is the biggest risk which investor needs to be aware of. But from your entire investment committee and management perspective, what are the measures, or what are the, I would say, yardsticks, or what is the process that you follow to contain risk?
Sure.
When you do these agreements with the earlier investor or directly with the management, if you write any shareholding agreements and all, I'm sure there will be certain conditions that maybe promoter has to come up with the IPO within, say, this stipulated time period. If he's unable to come, how will you exit? Because you have to be keeping in mind, exit at the time of writing the check.
Yes.
You are cognizant of discount, and you start your discussion with valuation and maybe with discount in keeping in mind, right, entry point. But at the same time, how will you exit is something which I'm sure you will also be keeping in mind. How does that work out?
Sure, Kamal. So I think first and foremost, I think the way we work is while secondary market really starts with the seller, right? A seller comes to you, or you reach out to a seller in a particular asset that you would be very keen for, and really try and start discussing. The first and foremost thing that we do is, once we have gone through and diligenced an asset, and I'll come to the diligence part again, the first thing that we really want to do is get the founder on our side. Be completely aligned with his objective, because if the founder is not aligned with us and our thesis and our timelines, then there is no point of even doing that investor, irrespective of the discount you're getting, because we will post-investment, you will be following different paths. So the first and foremost thing that we do, and IC also plays a very important role there, is to get aligned with the company founder, so that we are aligned in terms of the paths that we would like to go for, how we would like to support the company, what should be the endeavor from a company perspective towards our exit, towards listing, or towards any other strategic roadmap that the company would have. Because once that is solved, you've really solved a key milestone in that entire transaction. Then you are working alongside the founder, helping the company instead of just helping the investor. That's the first part. The second part in terms of risk mitigation is, again, when we look, of course, valuation plays a very, very crucial role in terms of our deliberations. And only once we feel that we can get our sort of IRRs that we are expecting or hoping for, given the risk that we are taking, we would like to go ahead with the deal. The third thing is diligence, Kamal, that most of these assets. So while a lot of funds on the secondary side globally are doing portfolio assets where they have limited diligence across assets, our perspective and our thesis is go in depth in each of the assets that we are investing And we don't take a portfolio approach towards investing. It's not that there are 5 assets, we will just go and acquire those 5 assets. We treat it as one by one, each of the assets, and we'll work and focus on each and every asset. And therefore, we'll do our heavy diligence on each of the companies that we are investing. It could be part of the portfolio, that's separate, but our process, our thought, our alignment, our internal team's view, everything is done asset by asset, and therefore diligence follows that route. And the last part is, which is something that we hope we never get to, but still we have put in all our documents, is the kind of agreements that you do, not just with the seller, but the founder, in terms of plans, how company would grow, in terms of what happens if we are not able to exit within a period of time, what happens otherwise. Most often, we get extremely strong terms built in our agreements itself, where which sort of is another motivating factor from a founder perspective. How to ensure that it's not just alignment, it's also a motivation from their founder's perspective that our exit timeline should be sort of looked at very, very clearly. And again, what happens, Kamal, is these companies that we are coming in, as I said in the beginning, when we look at secondaries, we are not coming as a new investor into a company typically, right? It's something that one or the other investor has been there, has guided the company for 7, 8, 9 years, sometimes 10 years, has seen that journey, has seen the difficult times through. It's only the last 2, 3 years which needs to be solved, which is where you step in. And therefore, it's again a huge risk mitigation that you're not wanting to solve for the very difficult period. The first few years of a company's life cycle is the most difficult period. And it needs a lot of guidance at that point in time. Having said that, when you come late stage, again, a secondary transaction itself, you have mitigated all of those risks in a reasonable way. And that's another element that we do see, that are there some more cycles left in this business before it sees our eventual exit? Or do we feel that the cycles have already been gone through and the business has also sort of stabilized more than enough for us to see that there's no major headwind that could derail the business in any way?
Sure. If I kind of, see the entire private market of various companies who would be at late stage, I think there will be 2 types of businesses. One, which will be primarily kind of bootstrapped with 80 to 90% ownership in the hands of promoter family or founders, around 90% or more. And there will be other type of companies which have been diluting equity over the years and which have been taking funding from various funds. So out of these 2 types of companies, which are the kind of companies which you will be eyeing for? Because, why I'm asking this question from exit point of view, because if there are many other investors like you who have been investing into this company and you also come as another investor, then exit will become difficult because there will be competition, while exiting also. And, you ultimately, one big risk which you are trying to solve is exit, and which your new investor is taking, in this fund is exit. And you're obviously trying to contain that risk. Hence, it's important to understand the kind of, in cap table or, invest earlier investors, how many earlier investors, are these some of the conditions that you will keep in mind while investing, while selecting a type of company or shareholding pattern before you invest?
Sure. A great question, Kamal. I think the way we see, okay, let me just start from how we start a process. I think first and foremost that we would like to see is the business economics and business scale really being there. That's the first determinant. If that's not there, we would not want to invest irrespective of the size of capital. Now, then comes the next part, is where you're saying founders either having a very large stake or investors having a very large stake. I think if you think of it, this plays both ways, right? If the founders have a very large stake, that means that they have also not seen a lot of private equity money, the way that they would like to manage, etc. While the other side has already gotten habituated. In fact, it's ready for its new phase of growth as well, because typically you need to deal with shareholders, you need to deal with multiple stakeholders when you're growing that company. So I think from a nuanced perspective, one is selling pressure, which is one part of it, where what is the future selling pressure that could look like. But I think the bigger part is that what's the size and scale which is there. Now that's number one. I'll give you two examples. One of the companies where we had invested, the founders had only about 12-14%. Now what we realized is that the business is doing, as I was saying, it was an inflection point. But there were certain investors which have stayed invested for a very long period of time, and there is a very visible sort of time frame that these guys have to look for an exit. When we discussed that company, only once we were very keen that yes, this makes sense, we negotiated a greater discount to enter because of this potential for the secondary that could be there. We sold for additional discount. What we also got was the moment the cap table positions were sort of, or the problems, as you rightly said, that there could be a lot of selling pressure on the stock. The moment that went away, there was a huge re-rating that played out, and we see this time and again. So if you're coming in companies where there are multiple stakeholders into an asset, we solve it either by taking that appropriate further discount to whatever is the FMV. That's one way to solve for it. The other way to solve for it is also when we are doing our agreements. We also have built our exit clauses, which are no more inferior with any of the existing ones, right? But beyond a point in time that everybody from an exit perspective becomes pari passu. And therefore, we are able to solve that. Now, Kamal, on the second point, that even if, let's take this argument forward, that there are multiple stakeholders. We have had companies getting listed in the Indian market, which have had more than 60, 70, 80%, in fact, some cases 90% investor shareholding as well. And we have seen that assets have taken that, or investors have taken that in the right light, that if the business is doing good, if there is no sudden selling pressure that the investor creates, then the markets really treat them quite well. And it's only a gradual process of exits that happen. And we've seen this play out in multiple companies, that an asset is great, irrespective of the supply that is there. If it's not immediate, the immediate supply is a big red signal for us, that if there is a immediate supply, which is after our investment as well, will keep hanging in terms of that company's prospects, then we would not like to do it. But if that's largely solved, then even if it's a larger shareholding, which would like to get exited over a 3, 4, 5, 6 year perspective post listing, then it's easily manageable, which is what we have seen. So our endeavor is look at great assets, number one, and then negotiate the pricing depending on the kind of construct that comes from various investors. If there are multiple investors, what we have also seen, Kamal, is that at times you're able to negotiate a much better pricing with one or the other investor because he could be more interested in terms of selling. So if that is there and we are able to solve for our exits mechanism, as I explained a few minutes before, but if we are able to solve for that, then that could be a great investment for us as well. So I think picking right, ensuring there's no cap table hangover, which is post, and picking scaled up companies which are close to profits or already profitable, gives us that edge in terms of being able to ensure that from our eventual exit perspective, we are not impacted. The last thing that we have done, Kamal, is while the fund is a 6-year fund that we are working for, the exit time frame that we are locking with the investors, with the companies that we are investing in, is much lesser. We are saying 3-4 years, so that we already build in that 2 years. We will not do a 6-year investment in a 6-year fund practically. That's not something that that's been our learning as well, and that's something that we would like to ensure that does not happen.
Sure, Sandeep. How many companies you aim to add in a portfolio, and per company allocation?
Sure. So I think from our perspective, we would like to build a portfolio of 20-25 companies in between that zone. We've already invested in 10 companies, of which 6 are the main companies for our smaller stakes that we have taken. But largely a good check size for us will be about $25 to $35 million. I think, again, Kamal, coming back to the previous point I was making, I think while the competition, in fact, from that perspective, is there, from a secondaries perspective, there have been very few players from a domestic standpoint which have really come and raised funds until now. People are conceptualizing, or people are about to start off thinking. It's largely few global players. and they have had either limited India capital or they are looking at only few deals, which means that there is a definite size threshold. They would like to do deals with which is a single check size of 60, 70, 80 million dollars or $100 million plus, and so on and so forth. And therefore, there's a huge white space, which we believe in that 25 to $75 million range, which is where we would like to play either lead that round or perhaps across our funds look at solutions that we can do solve for the entire position. From this specific fund perspective, 25 to 35 is where we would say a good sweet spot for this fund. Sorry, Kamal, you're on mute, I think.
Sorry, I was saying there are questions on taxation, so I will just maybe give my understanding that long-term capital, long-term in unlisted space is like more than 2 years, and long-term capital gain tax if company gets listed and you exit after listing is similar to listed space. But if you exit like in the unlisted market, it is a short-term capital gain if it is within 2 years, and that gets added in income. But if there's anything that extra beyond this you want to kind of highlight about taxation to cover this particular aspect.
I think that's perfect. Kamal, the only thing I would like to add is the fact that in a Cat 2 fund, what happens is the taxation is at the investor level. So all the profits are passed on to the investor, and each investor is charged at his own level, and therefore they can do the planning for that, as compared to a Cat 3 fund where the taxation is done at the fund level itself.
Right. If I may understand, what's your company's personal skin in the game in this particular fund, and if there's any investment committee skin in the game, like you being fund manager, senior EVP, managing this fund, because at the end of the day, people behind the product determine the performance, and it's like the more concerned you are about, the performance in terms of both, I would say, risk as well as the alpha, the better experience investors get, and that gets determined by the skin in the game. Sure,
Kamal. Thank you. I think again, I would like to split this instead of going specific into this particular fund. I think our sponsor capital across our funds has been anywhere between, so regulatorily you need either 2.5% or 5 crores, whichever is minimum. Starting from there is what we have until about 8-10% in some of the funds as well. Likewise, we have a very meaningful number in this fund as well as we speak, where we have invested. I think from our alignment perspective, there are a few specific areas that are built in our thesis as well. Number one is, of course, our performance, and our motivations are completely linked to the performance of the fund. The second piece is, of course, the carry, which is also linked, where you are able to get better share of the carry if the fund only does better, otherwise you are not there. So there's full alignment, not just at the sponsor level, at the IC level, but also at the team level, where everybody is equally motivated in terms of ensuring that this is the delivery on this fund is amongst the top quartile, and is able to give the investors the expected alpha that one would look for.
Sure, Sandeep. I think we have covered almost every aspect. I'll just like to give one disclaimer that this being a category 2 AIF, and in general AIFs are governed by private placement norms, so we cannot particularly discuss about a product. It is a webinar which was aimed, and intention was to discuss the concept, which has been kind of discussed completely and comprehensively. If still there are any questions which audience feels that are unanswered, you're most welcome to connect with us. At PMS AIF World, we are focused in the space of alternatives, and we'll be more than happy to take your questions. You can come to our platform, PMS AIF World, book your appointments with us, and we are kind of we'll be personally engaging with each one of you, because every investor has a different risk profile, and depending upon your existing portfolio, time horizon, or risk profile, we'll be happy to kind of guide you and happy to kind of help you shortlist a suitable investment for yourself. And this definitely investment is interesting and maybe is meant for certain class of investors who are like wanting to put money for horizon like 6 year plus, and for that liquidity risk that the fund offers maybe a considerable return, which definitely is kind of quite promising. You are more than welcome to discuss with us. Thank you so much, Sandeep, today for sparing your time on sharing your insights, and good luck to you for future. Thank you.
Thank you so much, Kamal. Thank you everyone for joining the call. Thank you.